Welcome to the deep dive. It's incredibly easy to walk around today and just assume the digital world is made of magic.
Right.
Like you tap a piece of glass in your pocket and instantly you are streaming a video or downloading some massive file or holding a video call with someone on the other side of the planet.
And we don't even think about it.
We don't. We call it wireless. We
Yeah.
call it the cloud. And it all sounds so, I don't know, light and invisible
Yeah.
and completely effortless.
We've built this entire modern vocabulary around pretending the internet has no physical weight.
Yeah.
We treat data like it is just floating in the atmosphere, waiting for us to pull it down whenever we need it.
But if you actually pull back the curtain, or I guess if you literally dig up the dirt,
Mm-hmm.
you realize our entire modern existence is heavily, deeply physical.
Oh, absolutely.
Every single piece of
Yeah.
invisible data relies on very real, very heavy physical infrastructure. And today we are doing a deep dive into a company that builds the literal physical backbone of that digital world.
Which is such a fascinating pivot from the usual software talk.
Right. We are looking at the Q2 fiscal year 2026 earnings report from Optical Cable Corporation, or OCC for short.
Released on June 8th, 2026.
Exactly. And the mission for today's deep dive is to look past the dry financial tables and really understand how a legacy hardware company engineered a massive profit swing in just a single year.
Because earnings reports, let's be honest, they often feel incredibly dry.
So dry.
Just presenting this wall of numbers.
Right.
But when you look closely at the underlying mechanics, they reveal the hidden architecture of the global economy.
Yeah.
And this specific Q2 2026 report is just a perfect case study in a concept called operating leverage. It shows how scaling physical manufacturing can create a sudden exponential jump in profitability.
Okay, let's unpack this. Because the best way I can think to describe OCC is that they are basically the plumbers of the internet.
That's a great way to put it.
Right. Like no one ever thinks about the literal fiber optic and copper pipes transmitting their data. You don't think about the plumbing until a pipe breaks.
Exactly.
But as this earnings report shows, whoever is manufacturing those pipes behind the scenes is quietly making an absolute fortune right now.
The plumber analogy works perfectly, provided we are clear about the scale and intensity of the plumbing we're talking about here.
Okay, yeah, fair point.
Because OCC, which by the way was founded back in 1983 and is headquartered down in Roanoke, Virginia, they aren't making the standard fragile Ethernet cable you buy at a big box store for your home router.
Right, this isn't the cable you trip over in your living room.
Not at all. They engineer solutions for enterprise markets, massive data centers, and what they categorize as severe duty environments.
See, the term severe duty sounds like marketing speak to me. What does that actually mean for a physical cable?
Well, it means survival in environments where standard equipment would literally melt, snap, or just disintegrate.
Oh, wow.
We are talking about military combat applications, industrial mining shafts, deep underground.
So like actively hostile environments.
Exactly. Petrochemical plants handling volatile materials, remote renewable energy sites. In these environments, if a communication cable fails, an entire industrial operation shuts down.
Right.
They even operate a facility near Dallas that holds a very specific military certification alongside all these international quality standards.
Why?
We don't need to get bogged down in the alphanumeric soup of the certifications themselves, but what they represent is a manufacturing process rigorous enough to produce equipment that survives extreme physical punishment.
So they have to be essentially bulletproof.
Basically. These cables have to withstand being crushed by heavy machinery, exposed to highly corrosive chemicals, or subjected to massive temperature swings, all without dropping a single packet of data.
See, that context makes the financial numbers in this report a lot more interesting to me because they aren't just selling a commodity.
Right.
They are selling hardened infrastructure.
Yeah.
And that infrastructure is clearly in incredibly high demand when you look at the headline numbers for their second quarter of 2026.
The numbers are wild.
They really are. Consolidated net sales hit $22.2 million. That is a 26.6% increase compared to the same period in the prior year when they were at $17.5 million.
And that momentum is accelerating in real time, too.
How so?
Well, if we look sequentially so, comparing this quarter to the quarter immediately before the growth curve steepens, net sales for Q2 jumped 35.2% compared to the first quarter of 2026, which sat at $16.4 million.
Wow.
Yeah, they are shipping out significantly more physical product quarter over quarter.
Now, a 26% year-over-year bump in revenue is solid. obviously. But revenue is just money coming in the door. It doesn't tell you how healthy the business actually is.
Right. Revenue is vanity, profit is sanity.
Exactly. And the part of this report that made me stop and actually reread the page was the bottom line. OCC swung from a net loss of $698,000 in Q2 of 2025.
But a pretty heavy loss.
Yeah, a heavy loss. But they swung from that to a net income of $1.1 million in Q2 of 2026.
This is a massive turnaround.
And this isn't just a one-quarter fluke either, because if you look at their first half results for the fiscal year, they brought in $38.6 million in sales and $657,000 in net income, recovering from a massive $1.8 million loss in the first half of 2025.
Going from a nearly $700,000 loss to a $1.1 million profit in a single quarter.
Right.
That represents a positive swing of almost $1.8 million.
Right.
It is an incredibly sharp inflection point for a manufacturing company.
So this is exactly what I want to challenge, because it doesn't intuitively make sense to me.
Why not?
Well, a 26% bump in sales is great, but how does that translate to totally erasing a massive loss and jumping to over $1 million in pure profit?
Ah, I see what you mean.
Normally, when you see a legacy company erase a massive loss that quickly, they are playing financial gymnastics.
Well, sure.
Like they got their research and development, or they lay off a significant chunk of their workforce to artificially suppress their expenses for a few months, just to make the quarter look good.
Right, the classic corporate diet. But what's fascinating here is the Q2 report shows the exact opposite happening.
Wait, really?
Yeah, they didn't slash their way to profitability. In fact, their operating expenses actively increased.
No way.
It's true. If you look at their SG&A, their selling, general, and administrative expenses, those costs actually climbed to $6.3 million in the second quarter of 2026, up from $5.7 million in Q2 of 2025.
Okay, so wait. Let me get this straight. They didn't fire anyone. Their operational costs went up by hundreds of thousands of dollars, but their bottom line profits still skyrocketed.
Exactly.
The math there feels contradictory. I mean, if you are spending more money to run the business, your profit margins should be getting squeezed, not expanding.
The math resolves when you look at the gross profit. The report points out a massive, really disproportionate surge in the profit they made on the products themselves.
Oy.
Gross profit increased by 42.4% to $7.6 million in the second quarter.
Wow. So sales went up by 26%.
But the actual profit generated from those sales went up by over 42%.
That is nuts.
The higher expenses in shipping and sales commissions were completely overwhelmed by the efficiency of the manufacturing itself.
Oh, okay. Here is where the concept of operating leverage finally clicks into place for me.
Yes.
It is a business mechanic that is just crucial for anyone to understand. And here is where it gets really interesting. I love thinking about operating leverage through the analogy of a massive theme park.
Oh, I like this. Go on.
So when a company builds a theme park, they take on incredible fixed costs.
Right.
They have to buy the land, build the massive steel roller coasters, hire the baseline security team, and, pay for the electricity to keep the lights on.
Right. Huge upfront investment.
And those costs are fixed. Whether one single person shows up to the park or 10,000 people show up, the cost to run the roller coaster that day is pretty much the exact same.
The baseline overhead doesn't care about your daily attendance. The park costs what it costs to open the gates.
Exactly. So for the first few thousand tickets sold, all that revenue is just going toward paying off the daily cost of keeping the park open.
Right.
The park might actually be operating at a heavy loss for the first half of the day, but once you hit the break-even point, the financial physics just totally change.
Because the roller coaster's already running?
Yes. The cost of letting one additional person ride is basically zero. Every single ticket sold after that break-even point is almost pure profit. So the higher your fixed costs, the more dramatic the profit swing becomes once your volume pushes past the break-even point.
That is a perfect analogy. Now, take that theme park roller coaster and replace it with a massive, energy-intensive extrusion machine in a Roanoke factory.
Okay.
The fixed costs in heavy manufacturing are immense. OCC is leasing large industrial facilities in Virginia, North Carolina, and Texas.
There you go, right?
Huge. They're running incredibly heavy, expensive machinery that wraps fragile, hair-thin glass fibers in Kevlar and thick industrial plastics.
Right.
They have to maintain the rigorous testing environments required to keep those military certifications we talked about earlier. They have salaried engineers and plant managers.
Right. People you have to pay regardless of how many cables you sell.
Exactly. So when sales volume is low, like it was in 2025, Those massive fixed costs weigh heavily on the margins, dragging the company into a net loss.
Because they simply didn't sell enough tickets to pay for the roller coaster.
Exactly. But in Q2 of 2026, global demand spiked, and they pushed significantly more volume through those exact same factories.
Ah,
The building leases didn't increase, the machinery was already paid for, the salaried engineers were already on staff.
right. The costs were fixed.
So because the fixed costs stayed relatively stable, the revenue from that 26% increase in sales fell almost directly to the bottom line. The factories simply ran more efficiently at a higher capacity.
That makes so much sense.
And CEO Neil Wilkin explicitly credited this dynamic in the report, stating that their manufacturing operating leverage contributed to the disproportionate increase in gross profit during the second quarter.
It changes the way you look at a business entirely. They increased their gross profit margin from 30.4% to 34.2%, not by making a cheaper cable, but just by making more cables in the same building.
Precisely.
And you can see that same leverage effect happening in their administrative costs, too. Even though their expenses went up in raw dollars from $5.7 million to $6.3 million as a percentage of net sales, those expenses actually dropped from 32.7% down to 28.2%.
Yes.
So the factory got more efficient, and the corporate office got more efficient at the exact same time.
It creates a compounding effect. When manufacturing leverage and administrative leverage kick in simultaneously, a moderate increase in sales creates a massive explosion in profit.
But, for the factory to run that hot, you need a serious catalyst. People actually have to be buying the product.
Right.
And jumping 26% in a year in heavy manufacturing is no small feat.
Yeah.
Where is this sudden burst of demand actually coming from?
Well, the report highlights robust demand across their enterprise, data center, and severe duty markets. But the geographical breakdown is what really reveals a major shift.
Oh.
Net sales to customers in the United States increased by a very solid 21.2%.
Which is great.
It is. But net sales to customers outside of the United States exploded by 45.3% in the second quarter compared to the same period last year.
Wait, really? A 45% jump in international sales in a single quarter?
Yes.
That means this isn't just a localized domestic infrastructure push. It looks like a global scramble.
And if you look at the first half of the year as a whole, international sales are actually up 32.4%.
Wow.
The demand for specialized, severe-duty infrastructure is being driven by a worldwide need to upgrade and harden communication networks.
Right, because everyone is upgrading at once.
Exactly. As data centers expand globally to support AI and cloud computing, and as industrial operations modernize, the physical foundation supporting those networks has to be built and installed. OCC is catching the tailwind of a massive global capital expenditure cycle.
Okay, so we have established how they crushed Q2. We have unpacked how operating leverage turned a solid sales increase into a massive profit. But, financial reports are essentially historical documents.
Very true.
They tell you what happened 3 months ago. To figure out if this turnaround is a temporary spike or the beginning of a sustained boom, we have to look forward. And in this report, the future is quantified by a metric called the backlog.
Yes, the sales order backlog, or what the company sometimes refers to as their forward load. It provides a window into their upcoming quarters.
And the numbers on this forward load are wild. At the end of Q2 2026, OCC's backlog increased to $13.3 million.
Which is a huge jump.
To put that in perspective, as of January 31st, 2026, it was $10.4 million. That is an increase of over 27% in just a few months.
Right.
And if you go back to October 31st, 2025, the backlog was only $7.3 million. It has grown by more than 82% in roughly 6 months.
It is a massive quantifiable acceleration in future commitments.
But I want to pause here and challenge the terminology for a second.
Okay.
Because in normal everyday life, the word backlog has a really negative connotation.
Sure.
If I tell you I have a backlog of emails, it means I am drowning and failing at my job.
Right.
If a video game company says they have a backlog of software bugs, it means their product is broken and the players are angry. So what does this all mean for the listener? If a company's manufacturing backlog is growing by 82% in 6 months, isn't backlog just a corporate buzzword for we are severely behind schedule and our customers are probably annoyed?
If we connect this to the bigger picture, that is a common assumption when viewing industrial metrics through a retail lens.
What do you mean?
Well, we are used to consumer supply chains where we expect a product to arrive on our doorstep 2 days after we click a button.
Right, the Amazon Prime effect.
Exactly. But we have to separate retail consumer expectations from business to business manufacturing realities. In the world of complex, severe duty manufacturing, a massive forward load is not a sign of failure or delay.
Okay.
It is a crystal ball showing guaranteed future revenue.
Because the customers ordering these cables aren't expecting next-day delivery anyway.
Not at all. When a petrochemical plant or a new mega data center orders specialized infrastructure, they are projecting their construction needs quarters or even years in advance.
Right, they're planning way ahead.
Laying miles of heavy-duty fiber optic cable is part of a massive capital expenditure project requiring extensive planning, trenching, and engineering. They place the order with OCC to secure their place in line for the manufacturing capacity.
Ah, so it's a reservation.
Basically. For OCC, a $13.3 million backlog proves that end-user demand across these global markets is currently outpacing their immediate manufacturing supply.
They literally have more clients wanting to give them money than they have time to run the extrusion machines.
Exactly. And this forward load fundamentally de-risks the forward-looking statements made by the leadership team.
How so?
Well, in the report, CEO Neil Wilkin states, as we look to the second half of the year, we are confident in OCC's ability to capitalize on our momentum and our continuing opportunities for growth.
See, but CEOs are essentially paid to be optimistic in earnings reports.
Sure.
You never read a corporate filing where the leadership team says, honestly, the next 6 months look pretty bleak. We have no idea what we are doing.
Right, that optimism is usually required. But in this case, Wilkin isn't relying on blind hope or a vague sense of market momentum.
Right.
He is looking at a guaranteed $13.3 million pipeline of orders that are already legally on the books.
So the money's practically already there.
Exactly. That forward load is the mathematical foundation for his confidence. It ensures that those manufacturing facilities we talked about are going to continue to run at a high capacity.
And because we now understand operating leverage,
Yes.
we know that as long as those factories run at high capacity, the fixed costs are covered. And a disproportionate amount of that $13.3 million is going to fall directly to the bottom line as pure profit.
Exactly.
Man, it is such a brilliant lesson in the mechanics of scale. OCC's journey from a Q2 2025 loss to a Q2 2026 $1 million profit wasn't about reinventing the wheel
No.
or discovering some magical new technology or firing half their staff. It was simply about scaling volume over their existing fixed costs.
It's textbook business fundamentals.
It really is. And as we wrap up this deep dive, I want to challenge you, the listener, to take this concept of operating leverage and apply it to your own life or your own business.
I love that.
Where are the fixed costs in your own workflow? What is a system or a process you have already built where the cost of doing it one more time is practically zero? If you can identify those areas and push more volume through them, you can yield a disproportionate increase in your own profits, whether that translates to actual revenue in a business or just, more free time in your week.
That's a great takeaway. And while you are reflecting on your own personal leverage, there is a broader takeaway from OCC's success that raises an incredibly important question about the future.
Well, what's that?
Well, as we discussed at the very beginning of this deep dive, we constantly talk about the cloud, right? We talk about artificial intelligence and the magic of wireless technology.
Yeah.
We treat the digital world as if it is entirely ethereal. But OCC's booming $13.3 million backlog for physical fiber optics and severe duty copper cabling proves the exact opposite.
It's heavily physical.
Exactly. Every single piece of that supposedly invisible data relies on very real, heavy physical cables buried deep in the dirt, submerged across oceans, or running through harsh, dangerous environments. The digital world is fundamentally physical. So as our data needs grow exponentially toward infinity, with more streaming, more data centers, more complex AI models, what happens when we simply run out of physical space or raw materials to lay the heavy physical pipes that make this supposedly wireless world possible?